deploying gold, I think basically she is right, because if, let us say, fiat currencies collapse in their purchasing power, then you don't sell your gold for currency so much, but what you would do is you would use gold to purchase assets. You'd probably use silver to purchase day-to-day sort of, if you like, the things we need to live on, like food and all the rest of it. It is interesting. I often quote something from a book by an Austrian author of renown called Stefan Zweig, who recounted that in the German inflation in 1922-23, you could have bought a property, a six-bedroomed house, swanky part of Berlin, for $100. Now, I don't know how many zillions of paper marks that was. I'm sure it was huge barrow loads of paper currency. But the point is that was the equivalent of just under 5 ounces of gold at the time, because the exchange rate, the gold exchange rate with the dollar was $20.67 to the ounce. I think she is right in the sense that you would use your gold to purchase assets, because the effect of a collapse of the currency is completely to destroy the value of assets, and even property values will go down. Bear in mind that everything we deal in is credit. Even under a gold standard, people never used gold in transactions. It was always credit. The difference was that credit's value was tied to gold. You had a lot more stability than we have when it is not tied. What they could do is go back onto a working gold standard. And under those circumstances, that then becomes the value in your own currency. But I really think we're a long way away from that. Perhaps a better question might be, is it likely that governments will ban gold ownership? It would be a very stupid thing to do, but I wouldn't rule it out, because governments tend to do things which are politically demanded rather than economically demanded. But I do think that if, let us say, we had a repeat of the 1933 confiscation episode, then I think that would just drive the price of gold far higher in the paper currency that is doing it. It would just alert everybody to what's going on. And I do remember when we had suddenly in this country, I think it was back in the 60s, we were banned from acquiring sovereigns, which is a coin of the realm, for goodness sake. And what then happened was that, as far as the dealers in sovereigns are concerned, the price went bid only. In other words, there was no stock on offer. And if you actually wanted to get some sovereigns, it was extremely difficult. It just went underground like that. It was Gresham's law. The bad money was driving out the good completely. So
both Macleod and Schectman emphasize the timeless utility of gold, especially during periods of fiat currency collapse. Historically, gold has served as more than just a store of value. It's a lifeline. Macleod illustrates this point by recounting a story from Stefan Zweig about hyperinflation in the 1920s Germany. During the Weimar Republic's collapse, individuals could purchase luxurious assets like a 6-bedroom house in Berlin for just $100, roughly 5 ounces of gold at the time. This anecdote highlights gold's ability to retain its purchasing power even when paper money loses its value. In the face of economic crises, gold often transitions from being a hedge to a functional currency. Schectman argues that in such scenarios, silver may emerge as the more practical medium for everyday transactions, purchasing food, fuel, and other essentials, while gold becomes the vehicle for acquiring larger assets like property or businesses. This dual role underscores the importance of holding both metals as part of a comprehensive wealth preservation strategy. Macleod brings up the historical precedent of gold confiscation, referencing President Franklin D. Roosevelt's Executive Order 610-2 in 1933, which mandated that U.S. citizens surrender their gold holdings to the government. While a similar move today might seem improbable, Macleod warns that governments often act irrationally during crises. A ban on private gold ownership could backfire spectacularly, driving the metal's value even higher in black market trades and forcing gold transactions underground. This historical context serves as a reminder for investors to consider diversification and perhaps even offshore storage options for their precious metals. In an interconnected world, protecting assets requires both foresight and flexibility. The BRICS nations, Brazil, Russia, India, China, and South Africa, are at the forefront of challenging Western financial hegemony. Both Macleod and Schectman highlight the group's efforts to create a parallel financial infrastructure that bypasses the US-dominated SWIFT system. Initiatives like BRICS Clear and the proposed trade settlement system involving gold aim to provide member states with autonomy and protection against Western sanctions. Schectman passionately critiques the Western financial establishment's arrogance in dismissing the BRICS initiatives. He recounts a recent statement by Augustine Carstens, the general manager of the Bank for International Settlements, BIS, who declared that the organization cannot support BRICS projects due to their ties to sanctioned nations like Russia. This stance, delivered at a high-level meeting involving the BIS, IMF, and World Bank, underscores the West's discomfort with the BRICS' growing influence. The hypocrisy, as Schectman points out, lies in the timing. Why wait until BRICS has already made significant progress to voice such objections? This reactionary approach reflects a broader theme of mistrust and fear within the Western financial system as it faces increasing competition from emerging powers. Gold's strategic value extends beyond individual investments. It's a geopolitical tool. Russia and China, in particular, have been stockpiling gold as a hedge against Western sanctions and as a foundation for their currencies. This accumulation reflects a growing recognition that fiat currencies, especially the dollar, are vulnerable to political weaponization. As Macleod notes, a collapse in fiat currencies would likely lead to gold being used directly for asset purchases. The destruction of paper money's purchasing power would drive individuals and nations alike to seek refuge in tangible assets. For developing nations within the BRICS bloc, trading in local currencies and settling imbalances in gold offers a pathway to economic sovereignty and stability. Both experts agree that the root of the global financial system's fragility is a lack of trust. From manipulated inflation statistics to debt-fueled economic growth, the Western financial model has sown doubt among global investors. This erosion of trust is why central banks, particularly those in emerging markets, are turning to gold as a reliable store of value. For individual investors, the lesson is clear. Trust in fiat systems should not be blind. Diversifying into gold and silver provides a hedge against systemic risks, offering a form of wealth preservation that transcends national borders and economic cycles.
I think that's probably something which she might just bear in mind.
I think it's disingenuous to say that Putin would be the only one to benefit from the multipolarity when it would really benefit all of these developing nations that want to use Bridge to trade a basket of local currencies, which would only strengthen their own economies. I think that it's very interesting that you had a meeting last week in Washington where the BIS was there with the IMF and the World Bank and all the Western policymakers. I think they got a little concerned about what was happening. And you get Augustus Carstens, who kind of looks like the kid from Willy Wonka, Augustus. And he says, and it's really gross. I mean, I'm sorry, I find it to be distasteful because they've spent all this time together. At the 12th hour, he comes out and says, we cannot directly support any project for the BRICS because we cannot operate with countries that are subject to sanctions. I want to be very clear about that. And Agatha Demarius, a senior policy fellow at the European Council of Foreign Relations. In the long run, there is no doubt that the mechanisms like BRICS Bridge would be useful for China, Russia, or others to hide sensitive transactions from Western authorities. The underlying technology is a tool to circumvent sanctions and potentially undermine the dollar's dominance in the global financial system. The hubris I find to be distasteful. At the same time, you had the BRICS come out completely reiterating their commitment to enhancing financial cooperation and cross-border payment solutions in a cooperative manner. I think as Steve had mentioned, you had an overt, almost in a marketing sense, drive to show that Modi and Xi Jinping are addressing their border issues. You had Saudi Arabia and Iran announce joint naval exercises. They're showing that cooperation is something that they're interested in. So, there's something called BRICS Clear that James Rickards talks a lot about. I would suggest people read that article where he basically says that This will be a ledger for these BRICS nations to trade back and forth with one another, free from the Western intermediation or the SWIFT system, and to settle monthly or quarterly on a net basis, not on a gross, where if Russia trades oil with for India for technology, those two things will offset, and then once a month or once a quarter, they will settle through the commercial banks that are participating and take the excess, the proceeds, whether it be due to a trade imbalance or whether it be, I just have too much in the way of ruble, I don't want any, and buy gold with it. He basically is saying it is a de facto gold standard, just without the pegging. What it is to me is they have, I think, really, this will reinforce and crystallize their motivation to break free from the West. And it won't happen overnight. But this is just a very underhanded way of doing things, where he says, I want to be very clear. Well, where were you a year ago? Where were you 2 years ago? And you bring it up now, it's transparent, it's gross, and there's probably a lot more to it that we don't understand, but I don't think it bodes well for the trustworthiness, which is something that is already lacking in this system, a lack of trust, as Putin said.
Schectman and Macleod both emphasize the hubris entrenched within the Western financial system. The dismissal of BRICS initiatives as a mere bluff ignores the tangible progress these nations are making toward creating a multipolar world. For Schectman, the reactions of Western policymakers at institutions like the BIS, IMF, and World Bank reveal a deep-seated fear of losing dominance. The irony, however, is striking. These same institutions spent decades shaping the very system that many countries now view as exploitative and are working to escape. Augustin Karsten's public condemnation of BRICS financial projects as a potential threat to global democracy only highlights the West's growing unease. Karsten's criticized BRICS' tools such as the mBridge cross-border payment platform and gold-settled trade systems, suggesting that they undermine the dollar's global supremacy. But this response, Schectman argues, is a short-sighted attempt to maintain control over a system that many nations no longer trust. The timing is particularly telling. Why are these criticisms being leveled only now, as BRICS approaches the operational phase of its initiatives? It suggests that the West underestimated the seriousness of BRICS' plans and is scrambling to counteract them at the 11th hour. This reaction reinforces the perception of a Western financial system that is reactive rather than proactive, a system that clings to dominance even as cracks in its foundation grow wider. The creation of BRICS Clear, a ledger system designed to facilitate trade among BRICS nations without Western intermediation, represents a fundamental shift in global finance. Unlike traditional systems that rely on the dollar and SWIFT for cross-border transactions, BRICS Clear allows member states to settle trades in local currencies and gold. This is a revolutionary concept in its simplicity and practicality, particularly for nations that have long felt marginalized by the dollar-dominated system. As James Rickards explains, BRICS Clear operates on a net settlement basis, meaning that countries only settle outstanding imbalances at the end of a predetermined period. For example, if Russia exports oil to India in exchange for technology, these transactions would offset each other. Any remaining imbalances would be settled in gold, not dollars. This process creates a de facto gold standard without the need for formal pegging, offering BRICS nations a way to insulate themselves from the volatility of fiat currencies. This system has profound implications for the global financial order. By enabling trade without relying on the dollar, BRICS Clear undermines one of the cornerstones of U.S. economic power. It also reinforces gold's role as the ultimate store of value, immune to the inflationary pressures and political weaponization that plague fiat currencies. In this emerging multipolar financial landscape, gold and silver are not just commodities. They are the backbone of a new system. As Macleod points out, gold has historically been the ultimate arbiter of value during times of fiat currency collapse. Its ability to retain purchasing power over centuries makes it a unique and irreplaceable asset. Silver, too, plays a critical role. While gold is often reserved for large-scale transactions or wealth preservation, silver's lower price point makes it ideal for everyday use. In a scenario where fiat currencies lose their purchasing power, silver could emerge as the medium of exchange for essentials like food, fuel, and clothing. This dual utility underscores the importance of holding both metals as part of a diversified strategy. Macleod frequently references historical examples to illustrate gold's resilience, particularly during periods of hyperinflation. One of the most striking examples is the Weimar Republic in Germany during the early 1920s. As hyperinflation rendered the German mark worthless, gold emerged as the only reliable store of value. A 6-bedroom home in an affluent area of Berlin, which would have required wheelbarrows full of paper marks, could be purchased for just 5 ounces of gold. This lesson is particularly relevant today, as many countries grapple with rising debt levels, inflationary pressures, and eroding trust in fiat systems. For investors, the Weimar example underscores the importance of having tangible assets that can withstand economic turmoil. For individual investors, the implications of these developments are clear. The old rules of investing no longer apply. Traditional assets like stocks, bonds, and fiat currencies are increasingly vulnerable to systemic risks. Gold and silver, by contrast, offer a form of financial insurance that transcends these risks. Macleod's insights into the nature of fiat currencies highlight their inherent fragility. Unlike gold and silver, which derive their value from scarcity and intrinsic qualities, fiat money is entirely dependent on trust. When that trust erodes, whether due to inflation, debt, or geopolitical instability, fiat currencies can collapse with alarming speed. Inflation, in particular, poses a severe threat. While official inflation statistics may suggest a controlled environment, Schectman argues that real-world inflation is far higher than reported. This discrepancy erodes the purchasing power of savings and investments, leaving individuals and institutions alike vulnerable to financial loss. The rise of modern monetary theory, MMT, adds another layer of complexity. MMT suggests that governments can print unlimited amounts of money to finance expenditures without worrying about debt, as long as they control inflation through interest rates. While this approach may seem appealing in the short term, it has historically led to higher debt levels, currency devaluation, and economic instability. For investors, the adoption of MMT principles underscores the urgency of diversifying into assets that are immune to devaluation. Gold and silver, as tangible stores of value, provide a safeguard against the inflationary pressures that often accompany MMT-driven policies. Both Macleod and Schectman emphasize the importance of sovereignty, both at the national and individual levels. For nations, accumulating gold offers a way to assert independence from Western financial systems and reduce reliance on the dollar. For individuals, investing in precious metals provides a means of safeguarding wealth in an increasingly volatile economic environment. The rise of BRICS and their efforts to create a parallel financial system signal a turning point in global finance. While these initiatives may take decades to fully materialize, their impact is already being felt. For investors, this represents both a challenge and an opportunity. Those who recognize the shifting tides and adapt accordingly are likely to be better positioned for the future. In conclusion, the insights of Alasdair Macleod and Andy Schectman highlight the critical role of gold and silver in today's economic landscape. As fiat currencies face mounting challenges, from inflation to eroding trust, the appeal of precious metals as true stores of value has never been stronger. For investors, the key takeaway is clear. The time to act is now. By reallocating even a small portion of their portfolios into gold and silver, individuals can protect their wealth and position themselves to benefit from the ongoing shift toward a multipolar financial system. Thank you for joining us in this extended discussion. In a world of increasing financial uncertainty, tangible assets like gold and silver offer a beacon of stability. The actions of central banks and BRICS nations serve as a powerful reminder that the future of finance may lie not in the promises of fiat, but in the enduring value of precious metals.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.